All right, let's jump right in. Instead of you paying to get into a trade, what if the market paid you to open one? Seriously. You enter the position and boom, money hits your account right away. And if you're right, that cash is yours to keep. Today, we're talking about how to turn widespread market fear into your own strategic opportunity.
So picture this. It's Monday morning. The market just had a terrible Friday, everybody's freaking out, and you can just feel the fear in the air. Now, most people's gut reaction is to either sell everything they own or just, hide under a rock. But what if that very panic is exactly what creates the perfect opening?
And this is where the mindset really splits. The amateur trader sees all this panic, they get scared, and they think, no way, I can't trade in this environment. The professional, on the other hand, sees that exact same panic and thinks, aha, this is where the real money is made. They see moments of high fear as moments of high potential.
So what is this big opportunity? Well, it all comes down to the price of protection. When markets are crashing, fear drives up something called implied volatility, which is basically just the market's fear gauge. And when volatility is high, put options, which are kind of like insurance policies against a stock falling, become incredibly expensive.
It's really just simple supply and demand, right? During a panic, you've got huge institutions buying puts to protect their massive portfolios. You've got retail traders buying puts, betting that things will get even worse. Everybody is a buyer. And when absolutely everyone wants to buy something, well, the smart move is to be the one selling it to them.
And that brings us to the professional's go-to tool for this exact scenario, the bull-put spread. This is how you become the seller. This is how you sell into that fear, and, believe it or not, how you actually get paid to take a bullish position in the market.
At its core, a bull-put spread is a specific kind of option strategy called a credit spread. And you know what? The name says it all. You receive a credit, that's cash, in your account the second you open the position. You get paid immediately.
And this is just a fundamental difference in how you can approach trading. With a normal debit spread, you have to pay money to open a position, hoping you'll make more back later on. But with a credit spread, the money flows to you right now. It completely shifts the entire dynamic of the trade. So what's the actual bet you're making here? This part is absolutely key. You don't have to be wildly bullish. You don't need the market to suddenly rocket to the moon. You simply need to believe that the panic is a bit overdone, and that the stock or index won't fall further from its current beaten-down price. Okay, so let's get into the nitty-gritty. How does this actually work? How do you put together a trade that pays you to be, cautiously optimistic?
It's a two-part trade. Let's use a real example. Let's say the Nifty index is at 7,805. First, you sell a put option that's just above the current price, maybe at 7,900. Now, because of all the panic, this option is really expensive, so you collect a nice pile of cash. That's your money in. But to protect yourself, you also buy a cheaper put option way down at 7,700. This is your safety net, and it costs you a little bit. That's your money out. The second part is what limits your potential loss.
Now, the difference between the money you got for selling that expensive put and the money you paid for the cheaper one is your net credit. In our Nifty example, that was 91 rupees per share. This is the cash that lands in your account right now, just for opening the trade, and that's your maximum potential profit.
And the beauty of this strategy is that everything is defined from the get-go. Your maximum profit? It's that 91 rupee credit you already pocketed. Your maximum loss? It's capped at 109 rupees. You even know your exact break-even point. There are absolutely no surprises. You're getting paid 91 rupees for taking on a clearly defined risk of 109.
So we know how to do it, but the real secret sauce, the thing that separates the amateurs from the pros, is knowing when to do it. With this strategy, timing is everything.
So, what's that perfect moment? A lot of traders might say, well, when I'm bullish. And that's not quite right. The real answer is when put options are expensive and you believe the panic is overdone. It's a subtle difference, but it's a critical one.
The ideal conditions are all tied to fear and uncertainty. Has there been a sharp drop in the market? Perfect. That spikes fear. Is there a big, uncertain event coming up on the calendar? Great. That creates anxiety. In both of those cases, implied volatility, that fear gauge, shoots way up, making put options super expensive. That's when the premium you can collect is the juiciest, and that's when you want to be the seller.
And this quote just captures that mental shift perfectly. An amateur sees the high price of puts and thinks, too expensive, and backs away. A professional sees that exact same high price and thinks, wow, these are expensive. I should probably be selling them. Beyond all the numbers and the timing, what makes this strategy so powerful is the psychological edge it gives you. It completely flips the script on how you approach a trade. Just think about it for a second. With a typical bullish trade, you pay money, and then you have to sit there hoping and praying the market moves up to prove you were right. With a bull put spread, you get paid up front. The market now has to fall and fall significantly just to prove you wrong. The entire burden of proof shifts from you to the market.
This means you start the trade with an edge. The market doesn't have to soar for you to win. It can go up, it can stay flat, it can even drift down a little bit, and you still keep that initial credit. The advantage is yours from the second you click trade.
So, I'll just leave you with this question. The next time you see those scary headlines about a market crash and you feel that little bit of panic setting in, what are you going to see? Will you see risk and fear, or will you see an opportunity to get paid?